it's B2C, I don't think that's ever possible. I think it is the Uber model. You just have to raise a Series G and H and I. It's not something I invest in. B2C models like that, to me, have never made sense. I mean, that is the ultimate unicorn, right? That's $1 billion plus either on your exit, but then you're diluted on 20 different raises, and you have to wait 15 years. I mean, it's really a long haul. I feel like early stage, Christian, from just pre-seed on a typical startup, it's still a 7-8 year exit.
Thank you so much for tuning into Journey with Christian DeEvans podcast. I'm your host, as always, Christian DeEvans, and we have a very special guest on today. I'm very excited about having her on. She's an early stage investor, serial entrepreneur, and CEO of DealFlowNow. She has an active portfolio of 40 plus companies. She is the managing partner and CEO of Lakeview Ventures, and we're going to be diving into some really fun stuff because a lot of angel investors, okay, one of the biggest things is you guys want to go out there and deploy amount of checks. However, though, you don't have the ability to understand all those intricacies or the due diligence or all the criteria, what that looks at when you're looking at an investment, and you want to make sure you have the proper information or data to identify and say, hey, this is a good investment to deploy. And that's the reason why we wanted to have Kelsey on. Please welcome my friend Kelsey August. How you doing today, Kelsey?
Wow. Good. How are you?
I am doing excellent. Well, before we dive into all this fun stuff about DealFlowNow and due diligence and the value that you bring into this ecosystem, I want to ask a little bit about your thesis, because you have been the managing partner and CEO of Lakeview Ventures for the last 30 plus years with a portfolio of 40 plus companies, which is remarkable. And I want to dive into a little bit of your thesis, the way you think about investing, the way you structure it, the way you look at it. Help me understand, Kelsey, do you gravitate toward one industry more so than the other, or what does that look like?
I am a serial entrepreneur, so I gravitate towards innovation and disruption. If I see something that is going to be the new shiny, needed object, I go towards it, which is not necessarily smart because there's such a huge steep curve on the learning process. So in order to deploy that out in the market, you really have to educate people. So I find probably the most cool things, like this year for 2023, the trend is novelty, investing in novelty products or services or IP. And what that really means is that there's a chunk of people who are disruptors in unknown or underutilized markets. So I think that's the spin, but it's always been happening, and it's called innovation and disruption, but now they're calling it novelty.
Interesting. So when you're looking at novelty and disruption and kind of innovation, when you're looking at a slide deck, right, of an investment or an idea, and they're pitching you, and do you look at the potential of market penetration behind it, or is it more of like, okay, is this product, this service solving a very, very, very difficult problem? And then you're able to say, okay, hey, I know the growth trajectory or the likeliness of this, hitting go to market is very likely, and you get a good return. What does that look like? Help me understand a little bit about your thesis. And you said disruption, cool. Help me understand that a little bit more at a micro level.
Well, that's a great question. I'll give you some examples. So right now, we're doing some fun stuff with a new partner, IBM, one of my portfolio companies 5 years ago, HR tech. And Angela created a technology that allows for no bias, no gender, color, experience preferential laying on to HR platforms, all the APIs of the world. And she now has enough data after 5 years of AI that's gone through the machine that literally all of the top candidates are populating, and you don't know anything about them until you interview them on what their gender is, what their color is, where they come from, what their socioeconomic background or education is. And I think this is a huge disruptor worldwide. IBM is about to launch it next month on all of their platforms across the world. So it is absolutely a game changer. For my brother has Tourette syndrome, and it's really hard when he starts to interview, people have bias. Can he do the job? Absolutely. I'm a female. My name is Kelsey August. When people, not so much now, but 20 years ago, I'd walk into a meeting and they thought it was a dude, right? And I'm like, hi guys, I'm actually a female. So it helped me, right, with Kelsey August, but Kelly August may not necessarily get you the job interview to start with.
Interesting. Okay. And so when you're looking, do you also emphasize a little bit about the founder and maybe their history, maybe what they had to go through, or are a lot of these founders, because it's so hard to, definitely in the VC and angel investing, because it's like this idea is really good, but also it may not be structured with the right founder. So do you emphasize the founder's kind of history and story, and hey, have they had a successful exit? Because if they have, then the likeliness of them achieving that again is obviously better. What does that look like?
Yeah, great question. I do. I fall in love with the founders. I really have to like my founder, and I really have to, they have to be amenable. They have to be coachable. They're usually, their personality is usually similar to mine. So that works out pretty well too. They're positive, and, they so believe in what they're doing. Obviously, it would help if they're a serial entrepreneur. So I look in that direction as well. Yeah, founders probably number one, Christian. I mean, I don't know. It's hard, right? Disruption, innovation, founder, they're all very important when in my thesis.
Okay, so you kind of start with the deal flow of now when you're looking at this, because see, what I found so interesting is sometimes like Uber, for example, we see this because we look at it in hindsight, it was a total disruptor. So are you trying to look at like an industry like HR or, manufacturing, whatever, and how technology can disrupt that industry through innovation in that kind of that structure? And is that micro as well, or what does that look like?
So I used to, back in the day when we were in person all the time, we're getting there. So that's exciting. I used to see literally physically 20, 30 pitches a month. So the entrepreneur would be front and present, and then you go through their pitch deck, the Q&A. So I would listen for disruption, because it's really hard to read when you get a pitch deck unless you go through it and it pops out. So it's really hard to find it, because it's not like I'm going to pitch day for just SaaS companies or pitch day. I'm going to all the pitch days, and then I have to kind of whittle out what makes sense. I'm invested in, yeah, go ahead.
No, please go ahead. What are you invested in?
Well, I'm like a vitiligo company. So a company that actually the pigment of your skin, even though I look like it because of the sun shining through, it makes it all the same pigment, so that people who have these white spots, these scar spots without pigment. And it's a disruptive market, because right now the technology used to do that, insurance isn't paying for it. It's $100,000. We found a way to do it in a local clinic for a couple $1,000s. So disruptive, innovative, new way of actually disseminating the pigment.
So when you're having this conversation, so this helps me understand a little bit about your thesis, what you look for. And, there's a lot that goes into it, and maybe a, 3, 6, 9 month kind of due diligence process. Do you, when you're having these conversations, do you negotiate it where, okay, depending upon, to mitigate your risk is basically what I'm trying to get to mitigate your risk, you say, okay, hey, I'll write a $500,000 check. Cool. And however, though, I want a percentage of all the profits until it meets that metric. And so I get my money off the table, if you will, and then I still own that equity. Or how do you structure to ensure that, hey, you know what, I like this idea. I'm not too sure of the proof of concept yet, or I'm not too sure with the founder, but I still want to be invested somehow, but obviously you want to mitigate that risk. So I'm just like, give me a contextual situation where, hey, you see it, it's an idea, maybe he's a first time founder, which there are a lot of founders like that, and there's no history of that. And so it's like, okay, well, I'm betting big on you, but in order to mitigate my risk or mitigate my loss to ensure that, that $500,000 doesn't go nowhere, maybe I could get some of the chips back. What does that look like?
Well, Christian, now that's innovative and disruptive, your little scenario. That is not necessarily playing out as much in the past, right? So this is a new thing that you've got, really talking about the concept of the formula of getting some maybe dividends or something special. I'm old school angel investor. I mean, I'm in it to win it. I'm in it with probably no real upside until I see a strategic partner or a Series A. Obviously pre-seed, we lose probably 80% of our investments on pre-seed, seed about 50%, and then Series A, only about 20%. So once you hit Series A, you feel pretty comfortable putting money in.
So do you try to hit the pre-rev? Because I understand the unicorn concept where it's like, okay, hey, it's that spray and pray kind of concept, which I think Peter Thiel talks a little bit about, and others, investors. It's like, hey, I'm going to write $25,000 checks to numerous because I understand the law of large numbers kind of work out in my favor in that regard. So is that your kind of thesis as well, and saying, hey, I'm going to look at this at a micro level, look at the founder, look at the history, look at this kind of, disrupting technology. There's no proof of concept in kind of the pre-seed and pre-rev situations. So you are kind of just like guessing a little bit. However, though, you can put more of a strategic guess, if you will, or guesstimation, if some people like to talk about. And then obviously, or do you kind of gravitate a little bit more Series A and say, okay, hey, let someone else as an angel investor invest those pre-rev. I'm going to focus on the Series A just because I do know my upside can be as much, but also my downside, it's it's decreased.
Brilliant, right? So I have to do that for my portfolio. I can only put so much money in pre-seed and so much money in seed because that feels like insanity if I put 100% of my money in pre-seed. So yes, the Series A and the B at least make sure that my portfolio is going to pay out.
Oh, I see. So what you're basically doing is saying, well, what does that ratio look like? Is that like, 60% in
Right.
pre-rev, 40%, or is it 60% in Series A and then 40%? What is that?
Well, the insanity was the early years of me investing. A lot of it was high risk, but I was a lot younger too. So it's probably 50-50, literally pre-rev rev.
Really? Okay.
Yeah.
Gotcha. And so, and I was not aware of this. So you have about 80% of the definitely pre-rev, pre-seed, 80% of that money is basically just eaten up. But when you get to Series A, there's an 80% likely that that's going to go to proof of concept and really scale, and there's only 20% likely that it's not. Correct?
Correct. Yeah. I don't think people understand that. I mean, Series A is pretty bulletproof. Series B is even more so, about 92% is what I've been reading.
Do you like to be more of an active investor where, hey, you know what, I'm going to, bring my expertise, my network, my skills, et cetera, to it? Or are you more of a passive and say, hey, I want to be a board and I just want to be a mentor or someone that can bounce ideas off and let the founder, run it? What does that look like?
Yeah, my background is marketing. So I think marketing is universal and I can be very helpful and instrumental, but I know very little about life sciences. So even though I see something cool, I'm probably not your girl to help you out in any way. So I'll back out and I'll help with fundraising and I'll help with maybe business structure and positioning with employees and such. But the areas I know, I do a deep dive in, and the areas I don't, I'm just curious about, and I'll get my monthly updates and I'm around if they ever want to call me and ask me a specific question.
Kelsey, I would imagine there are certain circumstances, and I never like to play this out like negatively, but I would imagine, I like to have the real and raw conversation sometimes as well. And I would imagine with some of these founders, you see the writing on the wall, they're burning through cash, the burn rate's pretty high, and you have to have those tough conversations. They keep coming and saying, hey, Kelsey, can you write another, $500,000 or 400 or whatever it may be? And at some point you have to have that tough conversation, say, no, I'm not able to because, X, Y, Z. So what are we going to do from here, right? And having those tough conversations. What does that look like, and how do you approach that to ensure, hey, I want to make sure, like you mentioned, I'm in it to win it. I want to help this founder explode, but also maybe we need a bit of longer runway, and you're not the person at the moment to do it. You may need other individuals or other investors to be able to, allocate that money to extend that runway out.
Well, in my due diligence, right when I start the process in the front end, I find out personality profile wise, what type of entrepreneur they are. Are they going to put me over a barrel, when they have a payroll that they can't make, on Friday? I don't go with those jockeys, and I do not get along. I go with the people who at month 6 say, okay, we need to really push this next raise in this round. Can you help me proactively, strategically? But you're right, you still get them. And I think that if the entrepreneur is always communicating to their pool of investors, and we do a pro rata raise to help them to get, a bridge raise until their next round. So I think it's collaboration, right? I mean, I don't think any investor should ever have to pony up. I think we all should pony up something if we believe in this product, this service, this entrepreneur.
Has there ever been a time where the founder or the CEO, the concept is maybe at a Series A or Series B, and it's rocking and rolling, you're kicking butt, but then the team itself, because at that point, that's when you start hiring and acquiring really good talent. But obviously, you want to make sure you're part of that, not maybe actively, but passively, and making sure that there's a structure and say, hey, I know how to build teams, et cetera, because of your extensive experience. And you start seeing the team in itself becoming poisonous. Do you help them facilitate a better kind of team culture or team orchestration to ensure that, hey, we're doing pretty well. We got a run rate of mid 7 figures, and we want to hit that 8-figure, 9-figure, et cetera. But there's certain things that we need to do, and having, again, internally, or is that more of like, hey, we're going to go ahead and just give the founder or the CEO a lot of that kind of leeway to hire and fire accordingly? Or do you come in and help them with the culture itself?
I personally come in and help with the culture. I'm a good sniffer outer. I know if there is maybe not a bad actor, but someone who's poisoning the well, and how to correct those situations really quickly. And I also know how to emphasize all the good things that are happening and to move them forward. And it's fun stuff. But, it's always interesting to me too, because some people think that they're building companies, and most of them are actually building out the tech or the product. And if you look at exits or acquisitions, they don't buy the company, they buy the assets, right? They buy whatever it is, the IP or, the service or product. They don't necessarily buy the people to go with it. They get 3 or 4 key hires, and then, it's gone. So sometimes culture, I don't want to say it's overrated, but, early stage, they got to grow it fast. So it's a very different mentality.
Well, is there a healthy, when you're looking at a business, and I'm talking more Series A, Series B, where you get this growth level, where you've got proof of concept, you go to market, you got some revenue going. I've seen some companies, and I've had some conversation with VCs, where when you shove so much capital, which has kind of happened the last few years in the VC world. Now, what I like about your extensive experience, you've been around for 30 years, so you've had the ups and downs, and you've seen where it's strict and obviously a lot of capital, et cetera, being allocated toward kind of the VC world. But I'm curious, when you are looking at this, it's like, do you like to see certain healthy metrics, right? And what I mean by that is like, okay, a burn rate at a certain level, Okay, we like to see revenue and margin increasing. So, because we've seen some companies that hit that billion-dollar valuation, but their burn rate is crazy and they're not actually profitable, right? They're negative EBITDA. And so I'm just intrigued, like, yeah, that's amazing. You've got an exit or whatever it may look like, but also may not be the best sustainable business long-term, right? And what are your thoughts on that?
Pose that differently for me. Good question.
Yeah, well, I'm looking at like when you're helping them scale to that next level.
Okay.
And there's different strategies to do it, right? You could really leverage a lot of, burn and cash and just, hoping that, you're going to raise more capital to shove it right back into the system. Kind of what Uber did, right? Their growth was amazing. Their valuation was amazing, but their burn was incredible, as well as they were negative EBITDA. They were not actually profitable for a long period of time. So they just had to burn through a lot of cash. Now, in that circumstance, you could exit, but it's not really a sustainable business because you're anticipating that you're going to keep raising capital to shove it back into the machine. Right. But I was just curious, when you're looking at your portfolio and having these conversations with your founders, do you like to say, okay, hey, you know what? We want a margin at a certain point. When we're hitting 5-6 million, we want a good margin. We want positive EBITDA. We want this. Like, we want to see these certain kind of checkpoints to say, hey, we are on the right direction to have a clean and healthy exit.
Well, and I think you can do that for SaaS and B2B and a service and CPG. But if it's B2C, I don't think that's ever possible. I think it is the Uber model. You just have to raise a Series G and H and I. It's not something I invest in. B2C models like that, to me, have never made sense. I mean, that is the ultimate unicorn, right? That's $1 billion plus, either on your exit, but then you're diluted on 20 different raises and, you have to wait 15 years. I mean, it's really a long haul. I feel like early stage, Christian, from just pre-seed on a typical startup, it's still a 7-8 year exit, right? So if you're raising more than a C round, I'm probably not going to invest. That's just too long for me. I'm getting old.
Gotcha. That makes sense. Now, when you said, and I like this, 7-8 years it normally takes, and I've heard that, from 5 to 7 or 8, where people want to exit at some point. So you write a check, it grew, wonderful, fantastic. Now, what does that conversation look like? I would imagine you are 3 years out and you're looking for someone to buy or acquire that company, or you're talking directly to that founder and saying, hey, how can I assist in making sure that we have a clean exit, getting some chips off the table. How do you negotiate that? How do you come around to having that conversation and making sure that there is a clean exit for yourself and for anybody else in the angel investor?
Yeah, the nice thing is I do try to stay close and connected, even if I'm not the person that they touch base with in the first few years. I want to see their growth and their ramp, and then I will engage and say, hey, listen, it looks like we have a possible strategic. Once you get a strategic, I don't know what the statistics are, but every exit I've ever had, once we get the strategic and we go through due diligence, within 12 months, the strategic buys us. So when a strategic comes in is when I tell them, hey, if someone's tapping on the shoulder and it's our exit plan, get me in the game. So that's really fun, because then you really, to your point, you set the bar and you set all the goals and the milestones that you have to hopefully achieve in order to get a certain exit valuation.
What are those? And I know it's probably contextual depending upon the company, but what are those kind of checkpoints to maximize that valuation? And like you mentioned, I like what you said there, making sure you have a strategic partner and facilitating that conversation, that dialogue, because it may take 12, 14 months, 18 months, whatever it is, to obviously have a clean acquisition, whatever that may be. What does that look like? What are those checkpoints?
I think the checkpoints, again, I'm looking at all my exits and you always think it's sales. And for me, it has not been, mostly because I think that the TAM's very important, right? TAM plays a big part of that. If you have a huge TAM and your strategic, like an IBM, has 50,000 customers worldwide, then it's really not about revenue. What is it worth to the IBMs or the General Mills or whomever of the world? And I think that's how you back into your evaluation. What can they do with it when they buy it and they put it on their platform or they roll it out? And most of our strategics tell us, they're very transparent, because what they don't want is year two, you hear how well they're doing with what they bought from you, and you're like, woulda, coulda, shoulda, gotten more. I think a good strategic tells you what their year two and year three forecast is with your technology or your service or product.
So you go out and you have company A, and it's got to Series B, it's doing some pretty good run rate, maybe it's looking at Series C or whatever, and you're having that conversation of it's getting acquired. So you find that strategic partner comes in, wonderful. And basically what you're doing is you're aligning what they're looking for, and you're basically giving it to them and say, okay, hey, well, we have this, this, and this, or you need to do maybe internal structure a little bit to ensure that they're aligning that correctly, and then they're looking to acquire within that period of time frame. Have you ever negotiated where, definitely when you see a larger acquisition, and maybe it's $1 billion company that's looking to acquire this, whatever that runway is, the top line. Do you ever negotiate and say, hey, I want to carry on because I see massive growth still, carry on, and I still want, maybe I'll take a portion of it off in secondaries or whatever and take it, cash out? Or do you say, hey, I want to negotiate maybe another 1% or 3% or 5% in equity. I just want that to roll over into the larger company. Can you give me some more equity of this larger company? Have you ever negotiated that way?
Yeah. And in fact, I think most of the large companies do negotiate that way. Do you want our stock? Do you want to hold for 12 months? Sometimes make it mandatory a hold for at least 6 months in the equity option. Do you want to cash out? So I think it's all negotiable. And I think there's a lot of flexibility. If you're doing well and they really want you, you have the ability to cash out, right? It's not an all stock or equity deal.
So, well, in your circumstance, because I do know it's contextual, do you tend to gravitate that a little bit? Because I know equity long-term it builds a lot more wealth, but also it's not as liquid, right? So it's not as easy as to write more cash to shove back into more VCs and into more opportunities and so forth in angel investing. So what do you look for? Are you like, okay, $500,000, I've got 10% equity in this company, we're looking to take an exit out of it, wonderful. Do you just mitigate that and say, okay, I'm going to take 5% off and, keep 5% in the larger company, whatever it's acquiring? Or what goes through Kelsey's head to say, hey, you know what, I see growth and I want to keep on this train or on this unicorn, and I want to ride that even further? Or what mitigates and says, no, I'm going to go ahead and take all my chips off and go ahead and reallocate it toward and start the process again? What does that look like? How does Kelsey think about it?
Yeah, well, those are fun, right? Those are fun strategy sessions to go, oh, I've got a lot of money now. How am I going to take this in stock, or am I going to take some cash? I think then you jump on the market, right? You look at the stock market and you see how they're doing, what the volume that they're trading, margin calls, everything there. And, if it's a blue chip stock, I like a big position. I'm okay with that because then I can cash out at any time, any percentage. So I tend to do more equity and stock deals, maybe take 20 or 30% cash overall.
Okay, so if this company that's acquiring, it's a public company that's acquiring a private company, then you obviously look at that and says, well, obviously a public company is more liquid. So if you do take some equity or they give you some equity, then you can liquidate that a lot easier, unlike a private company or whatever. If that larger company is a private company that just acquired another private company, right? That the one that you invested in that circumstance, okay, what would you do?
I take my money.
Okay. Why is that? Help us understand why that is.
I won't really know as much going in with them as I can find out about a publicly traded company.
Makes perfect sense. What are your opinions on SPACs And I know that's like the new way of getting people into kind of the, and if not, if you don't have an opinion on it, that's okay. I was just curious because I know there's like a lot of different strategies behind that. It's been kind of a little bit more prevalent in the investor world and in regarding an exit strategy. But I just wanted to get your opinion on that.
Well, I currently have 40 portfolio companies that are alive. 2 that just went away were through SPACs. It's, I think it was something that we tried for the last couple years, and I don't know, I think it was hit or miss, and I think it was a Hail Mary pass, at least in one of the 2 portfolio companies I had, that maybe a SPAC could actually save us or get us to where we should be. But I don't see the stability of it. I don't know if we have enough data on it. But I'm uncomfortable when my portfolio companies consider that as one of their 3 options.
Why is that? What's your thoughts on that?
I don't know enough, and I've seen too many failures, and it doesn't seem the smartest play. I think the smartest play is doing another round. I think staying in the game with private equity is always smart. And I think that that's plentiful, and we can not control it, but we can actually manifest it and work with it. And it proves over and over that's a good road to travel.
Yeah, it's interesting to see the market right now because, and the reason why we're talking about the, kind of early stage to that, because like you mentioned, you have, 40 plus companies in your portfolio. And so some of them have gotten to that level where, okay, looking at IPO. And though statistically we have seen not as many companies have IPO'd recently as much as stayed private. And a lot of them are, because there's so much capital in the markets, they're shoving, I've noticed a lot of institutional investors shoving a lot of capital in that Series G, E, F, G kind of, situation where now they've got a ton of capital in that. They're still growing at exponential rates. And that's why, private equity and alternative investing, you're seeing better, IRR in that industry, which is very unique. So that's why I was just wanting to get your perspective on the SPAC world, because I know Chamath, he's talked a lot about that. He kind of, brought that a little bit more infamous a little bit. Now, Kelsey, coming back around to your company here with regards to DealFlowNow, help us understand a little bit about that, because I think it's a really good resource for a lot of angel investors, those that are listening right now, whether they want to deploy some capital towards some other things that they've seen. It is very tough to get access to the back end stuff, financials, all that stuff, even signing an NDA and really getting the due diligence of these companies that you're looking to invest in or the founders, et cetera. So how can DealFlowNow, how can they help a lot of these people and solving that issue of lack of data or lack of information that they have when they're investing?
So as you know, Christian, we launched last quarter of last year, and the goal was to get deals that myself, my portfolio companies who are doing another raise onto the platform that have success and traction. So usually they include a deal memo, they've been vetted out, they may have a VC in it, but they're at least pretty much seed looking for either an A or a bridge for a growth raise. And there's all these angels that are around the US that, whether they're a part of a group or not, have a hard time finding the deal flow for them, because all of us, I mean, literally, I joined an angel group 10 years ago here locally in Austin. And out of the 100 angels, I found one other person that had my exact same investment thesis. And I'm like, all right, you and I will co-invest in everything we do. And pretty much 80% of my investments are along with hers as well. So I think it's just, you need to find vetted deal flow that other angel groups support and can help syndicate in the raise. So DealFlowNow was the platform to utilize that as a tool, as we talked a little bit earlier. Now what I'm finding is that some of these groups don't have the bandwidth, or these super angels or investors have the bandwidth to do enough due diligence. And this has always been, I mean, I started doing this 25 years ago, angel investing in my 20s. And What I didn't do well then that I do really well now is that I do at least 20, 30, 40, 50 hours of due diligence. And usually at 10 hours, I can tell if I'm going to actually invest in the company or not. So that's kind of my make or break. After about 10 hours, I'm like, okay, I've got to let this go. So the ones that have 30, 40, 50 hours are the ones that I'm actually going to put some really good money and time and effort into. So a lot of the groups, a lot of the investors are like, I don't have, Kelsey, 30 hours. I've had 5 and I want to see this to go further. Can you ask these 50 questions and do these interviews and get their financials and do a deep dive and figure out, is it yay or nay? And then we do a scorecard of, TAM, market, team, exit potential, all of the criteria, and let them know if I would invest or what I saw as a yellow flag or a red flag. My yellow flags are not necessarily the same as other people, so they'll have to use that as they would. I think co-founders that are married could actually be a benefit. Other people call that a yellow flag, and I understand why, and it's to each his own. But obviously red flags, if you have more than 2 or 3 red flags, hopefully we won't go any further in the due diligence, right? Once you find that, hour 20 saying, do you want me to continue? Because I found these 3 things I personally would not invest, but that's up to you. We can go further and do more due diligence.
So your whole platform, which is really, really revolutionary, because I've seen this a lot of times. One, they have the resources, but they don't have the time, the energy, and they don't know exactly what to look for either sometimes. Like you mentioned, it's like, what questions should I be asking? So your platform can be able to go in there and say, okay, hey, these are the questions we're asking. This is the data we're getting. And then we bring that back into some sort of, slide deck information and say, hey, this is what's going on. This is what we have found. And then from that data, they're able to identify, hey, yes or no, from the data that you presented them. Now, correct me if I'm wrong, where do you guys get that information? Do you guys have a lot of internally, do you guys just have a lot of, resources and other kind of data sources that you guys use? And that's one of the reasons why it's very, very accurate. Or do you go out and, talk to the founder and talk to those individuals and say, hey, unpack this. Can you send me the docs? We'll sign NDAs, whatever it needs to be. And then obviously pull that together for your client.
Great question. I would say 20-80. So 20% is public information or information that we can pull on and derive synopsis from. But 80% is actually that digging in with the co-founders, with the executive team, and asking very specific questions. It's funny because about hour 10, when I said that earlier, it seems like hour 10, a lot of things start to crumble. And I do it in the order of priority, right? Like the first hour, I'm like, do we have any bad actors on the cap table? Do we have any potential lawsuits that we're aware of, any litigation going on, right? Because some of them in hour 1 don't get past due diligence. But hour 10, I'm sitting with the co-founders, and now sometimes because of technology, it's on Zoom and you've got 2 screens, and you actually ask them a question, and the way they answer or roll their eyes, I mean, that's the kind of due diligence that you'll never see on paper or hear. You've got to see it. And I'm like, oh my gosh, they don't like each other. This is never going to work. So it's really, all senses have to be, your spidey senses, everything has to really click on your due diligence list. There's a lot of ways to figure out what a yellow flag may be. And a yellow flag to me, you can have multiple, but if they can get over the yellow flags and that hurdle with the money that you're providing, I think that yellow flag goes away.
See, and this is why I love these conversations, because it is so contextual. I have talked to numerous investors, and they all have their own thesis. They have their own way of doing things, the way they look at things, and what the story that they tell themselves. Hey, because of the finances, because of the story, because of the founder, et cetera. That then I know that this is going to be a good thesis or a good investment, and that's why I love having people like yourself on, Kelsey, that is able to provide this incredible tool. And it's very resourceful. It's very data driven and saying, hey, this is what we have. But also, I think you mentioned something that was very, very impressive, and I want to, foot stomp on it, is, the human behavior, right? Seeing the psychology, seeing the synergy, seeing what the founding and the co-founder, or, that team and how they respond to certain questions. You get this intuitive kind of experience and say, okay, well, what's going on there? Let's dive deeper into that. And so it may not be all on the data, but that's just got a feeling. So there's a lot of it that's very contextual. Kelsey, because you've been in it for so many years, and DealFlowNow is just rolling this out, which is very exciting to see this. You're seeing a massive need for it. What was the reasoning? What was the mindset behind it? Just because you're like, what, I struggle with it, and then I want to just add value to other people that I've networked and connected with, or was it just like you have a desire to find the right deals? What was the desire?
Great question. Yeah, multifold. I was spinning my wheels, seeing a lot of pitch competitions. I would go to a lot of meet and greets, and I would see things in writing and portals, but it wasn't ever vetted. And so I'm like, where can I go to find deals that I would easily be able to get involved with? But we're so desegmented, and it's decentralized in such a horrific way. Not only are the angels not working very well together, but then what happens when I can totally do seed, A, bridge, I dabble in B, dabble in pre-seed, but most investors really have I would say a stricter or more defined thesis that they really feel comfortable in Series A, because I'm going to at least get, 80% of the time I'm going to make a nice win. So where do I send them after I have done all that I can for them? So it was also a bridge of, okay, here are some vetted companies. If you like to invest in Series B, then help these guys out, because I don't have those connections, and nor do I have the time to make enough of those connections. There's 1,000 VCs out there. There are thousands of funds out there, 3,000 family offices. I can't possibly know them, let alone 5% of them. So yeah,
I love it.
Platform
I love it.
To shop good deals.
And that's incredible to see the passion as well as the vision that you have for this. And you see that there's a massive need for it. And because what I love about this is when individuals and angel investors have the data that you provide for them, giving them this service, they're more likely to deploy capital, which then helps, drive more ideas and dreams and actually make those come true. Because at the end of the day, the economy, in a good or bad way, it runs off the money to run the machine a little bit. And, this all facilitates the right direction, which is really awesome. Kelsey, for those that are listening, and I appreciate you being on here, just talking about your thesis, talking about your trajectory, talking about the way you think about things and your paradigm and the mindset, and just also mitigating your risk in your own portfolio. I think that's just a really awesome approach. For those that want to reach out to specifically DealFlowNow and getting access to this amazing due diligence process and this resource, how do they reach out to you and be part of what you got going on?
Just Kelsey, Kelsey at DealFlowNow.com. I'm also on LinkedIn. I'm actually more social than I've ever been, Christian. As you know, that's how we met.
It is. And guys, those links will be in the description below. So make sure you stop what you're doing. I'll put her LinkedIn. I'll put the website, as well as I'll put her email down there as well. So Kelsey, I really appreciate being on and making yourself available, and being on the forefront, doing this stuff and implementing this and giving value to this community. Kelsey, I always love to ask before I let you go, is there any last words of wisdom they'd like to share with our audience?
Oh, Christian, God bless you. To have the last word, that's just not me. I just think enjoy it, because we're blessed as investors to be able to help companies out and grow. And I think instead of getting all wound up or about execution or milestones missed, enjoy that we're part of the group that can make things happen.
Well said. Very well said. Guys, that is my friend, the CEO of DealFlowNow and managing partner of Lakeview Ventures, my friend, Kelsey August. Guys, that is Journey with Christian Evans podcast. Until next time, be uncommon if you can.